Hello, my friends. Today is July 29th. My name is Joseph, and this is Markets Weekly. This week was super exciting in global macro, so we have a lot to talk about. First, we have to go over the really positive data we saw in the US. It seems like the US is heading towards a quote-unquote soft landing. Secondly, we have to talk about the sweeping new bank regulations that the FDIC published for comment this week. This would be the biggest change in bank regulations for actually since several years. And we'll talk about how they might impact the real economy and the financial markets. And lastly, let's talk about what happened in Japan, where the Bank of Japan suddenly, with only a little bit of warning, tweaked yield curve control. And I think that's going to have a big impact on financial markets in the coming weeks. Okay. Starting with the US. So this past week, we got three really important data prints. First, of course, was the second quarter GDP print, which surprised to the upside. Second quarter GDP printed at 2.4%. Now, for context, the first quarter GDP printed at 2%. So what we're seeing is a re-acceleration of the US economy. Now, recall, just a few months ago, there had been many people in the markets calling for an imminent US recession, buying bonds, and so forth. And that view was not just wrong, but ridiculously so. In fact, if you look at forecasts for third quarter GDP, such as the Atlanta GDP now, you'll see that third quarter GDP, which is going to be revised as data comes in, and it's a very noisy number, is at the moment looking at 3%. And for further context, US trend, so potential GDP growth, is estimated to be about 1.8%. So the US economy appears to be reaccelerating and growing comfortably above trend. Now, when the markets saw these positive numbers, they were actually not that happy, because when you have strong GDP growth, when the Fed is trying to slow the economy down, that means that the Fed is probably going to have to hike rates more, or at the very least, keep rates higher for longer. And that's not positive for financial markets. But we also had another two important data prints. The first was, of course, the Fed's favorite inflation measure, PCE inflation, which printed lower than expected and confirmed the very soft June CPI print. And also we had the employment cost index, which is the Fed's favorite measure of wage costs. And the ECI printed softer than expected and confirmed the trend of wages moderating. So these last two prints, the PCE inflation and the ECI, appear to suggest that inflation is moderating. And markets really like these two prints, because if inflation is moderating, that means the Fed doesn't have to hike rates as much and may be cutting rates in the coming months. So if you put the two together, stronger economic growth and softer inflation, that's soft landing right there. That is the sweet spot for the US economy. Now, that's just a snapshot of the data today. Be mindful that that could change. As we've been discussing going forward, there is some potential for inflation to re-accelerate. After all, we have a structural labor shortage, and if GDP continues to grow so strongly, we're going to have to hire more people again, and that's going to lead wages to re-accelerate. And of course, if you look at commodity prices, price of oil, for example, seems to have bottomed and is turning higher. So going forward, we could again see inflation reaccelerate later on in the year. But so far, this is really good data. So honestly, if things continue this way, we could really have the Fed not hike anymore and cut rates later on in next year. But a lot of things can change. Okay, let's talk about the second thing now. The second thing is that the FDIC released for comments a whole bunch of new bank regulations. Now, these regulations are about, if you look at the proposal, it's about 1,000 pages in length, so we're not going to go over everything there. I'll just briefly highlight some of the most important aspects of it. First, these regulations are what the authorities are calling the Basel III endgame. So Basel III was a suite of regulations that was launched after the great financial crises. These regulations fundamentally changed how banks are regulated and thus how they could behave. But the full force of Basel III really applied to only the mega banks in the US. So that's your JP Morgans, your Bank of Americas, and so forth. The first thing that these new regulations do is that they expand the scope of Basel III to apply to a wider set of banks, specifically banks that have assets $100 billion or more. Now, these smaller banks, of course, they're not going to have the absolute full extent of Basel III, but they're going to have more of it applied to them. These are your regional banks. And that's the one thing. And the second thing is that these new regulations are going to mandate banks to hold more capital. Now, the biggest banks are going to have to hold markedly more capital, and these regional banks, they're going to have to hold a little bit more capital. So just for context, capital for a bank is basically loss absorbing capacity. It's a liability of a bank. So for example, if I start a bank, I'm going to have to put down some equity in the bank, right? Well, equity from my perspective is capital from a bank's perspective. So if the bank that I start makes a loss, then what happens is that the owners of that bank eat that loss. So the bank's capital holders, so the losses will come out of the bank's capital, which from my perspective is that as an equity holder means me. So the more capital a bank has, the more loss absorbing capacity a bank has. And so the bank becomes stronger, more stable, more resilient from solvency problems. And I think the third highlight that the bank regulations did is basically in reaction to Silicon Valley Bank. The new regulations mandate a wider swath of banks take into account unrealized losses on their available for sale securities portfolios when calculating capital. So before the regulations, only the mega banks, say the Bank of Americas, had to take into account unrealized losses on their available for sale securities when they calculate capital. The other banks, they did not have to take that into account. Now, the regulators looked at what happened at Silicon Valley Bank, who had large unrealized losses on some of their securities, and thought that, well, maybe if they had to take those unrealized losses into account when they were calculating their capital, they would have more capital, and thus their depositors would have felt more secure, and there would have been less of a chance of a run. So all in all, I think the one takeaway is that more banks are going to have to hold more capital. Of course, when you have to take into account unrealized losses on your securities portfolios and calculating capital, you're going to have to hold more capital. Now, what does that mean for the economy and for the markets? And I may have a post that talks about this more in detail later on. But broadly speaking, there's a trade-off for mandating a bank to hold more capital. On the one hand, if banks have more capital, banking system resilient, less likely for there to be runs, less likely for there to be a crisis in the banking sector. On the other hand, increasing capital basically increases the costs for a bank. Now, when the bank goes and raises capital, well, the people who put up capital demand high returns on their capital because it's a risky thing. You're basically putting capital to a bank, and that capital is at risk. So, if a bank has to hold more capital, they're going to have to pass on those costs to their other businesses. So, for example, the next time a bank makes a loan, they're going to have to take into account their higher capital costs. And maybe they're going to have to demand higher interest rates in order to pass that cost down. So the downside, of course, is that everyone who gets a loan from a bank, maybe they're going to have to pay a little bit more. Now, the regulations suggest, now they do their own studies, but they're regulators, so of course they're going to say this, they're suggesting that it's not going to be a big deal. And maybe they're right. But I would look at this more broadly from another perspective. That is to say that if you are someone who's dependent upon bank financing, let's say a small business or medium-sized business or an individual, you're going to have to pay slightly higher interest rates. But it's not going to have a big impact on the mega corporations, the Googles and the Apples of the world, because those guys, they don't borrow from banks. They can go and borrow from the capital markets. Apple can go and just issue a bond, and someone would buy it and lend to Apple at very low interest rates. So in a sense, it makes the playing field, these regulations make the playing field a bit more uneven, as those dependent upon bank financing will have to pay more, and those that are those that are not dependent will have a further financing advantage. The second big real economy point that I'd make is that whereas this is not good for banks because their costs go up, it's good for competitors of banks. So you can think of them as private credit funds, private equity funds, or BDCs, for example, which are also private lenders. And you can think that, well, if banks are maybe going to have higher costs, well, these other less regulated shadow banks, they're going to move in and try to take business from the banks. And they've been doing that for the past several years. So it will be good for them. Now, when it comes to the markets, one thing that I would note is that there is some special new things in this requirement that make it more expensive for banks to participate in the capital markets. So if you have a trading business, you're going to have to hold more capital against that. And that means that banks might be less willing to make markets. If you sell a treasury, for example, you sell it to someone who is affiliated with the bank usually, and that person then will hold that treasury and then sell it to someone else. Now, the more costly it is for banks to make markets, the less liquidity there is in markets. And so you can have easily more volatile price action and more possibility of, financial disturbances. Now, the difference is, of course, that the banks themselves are protected, but the markets that they serve less so. We saw this happen in March 2020 when the banking system as a whole was totally okay, but let's say the treasury market crashed. So you could have more of that going forward from these regs. Okay, the last thing we'll talk about is the change in yield curve control from the Bank of Japan. Now, our favorite central bank governor, Governor Ueda, has over the past few months repeatedly suggested that, I don't know about tweaking yield curve control, maybe. And the market has been speculating for some time that the governor at the Bank of Japan will have to tweak yield curve control. The market has been speculating on this for very good reason. First, inflation in Japan has been above their target. Japan, like everyone else in the world, has been suffering from high inflation. Secondly, unlike other central banks, the Bank of Japan hasn't raised interest rates. So the Fed, the ECB has been raising rates aggressively, but the Bank of Japan has been doing nothing. So everyone has been speculating that the Bank of Japan would eventually have to do something. And out of the blue, right before their meeting this past week, the Bank of Japan leaked to the press saying, guys, we might be talking about tweaking yield curve control. Now, it sounds really benign, but in central bank speak, this is basically saying, guys, we're going to tweak yield curve control, prepare accordingly, don't blow up. And just as they suggested in the leak, they did tweak yield curve control. The way that this tweak was implemented was that the Bank of Japan was telling everyone they're keeping their range for the 10-year yield at 0% plus or minus 50 basis points. The difference being is that they're only going to intervene if the 10-year yield goes above 1%. Now, that is to say that, if the 10-year JGB yield went to, let's say, 0.6%, in the past, the Bank of Japan would come in and buy a whole bunch of JGBs to try to get the yield back within the within 50 basis points. But this new policy tweak is saying that they won't come in and buy bonds if the JGB yields, 10-year JGB goes to 0.6%, but they'll come in if it goes to, let's say, 1.1% when it's above 1%. So in a sense, it's basically expanding their yield curve control framework. Now, the market reaction to this, I thought, was pretty interesting. At the leak, of course, we immediately saw the 10-year treasury yields move higher. So globally speaking, global bond markets are interconnected. So when you have the Bank of Japan essentially letting their longer dated interest rates move higher, that's going to put upward pressure on global bond markets. And I'm going to write more about this in detail in my blog post this week. So that reaction was exactly as expected. The second thing you would expect is for the yen to strengthen. Obviously, the Bank of Japan essentially increasing interest rates, all things equal, you would expect their currency to appreciate. But when the announcement finally came out, the reaction was surprising to me in the sense that the yen actually weakened. And the developed market bond markets actually didn't do that much. One interpretation of this could be that the market has been anticipating this for some time, and obviously it has. So it was in a sense already priced in. You can see that the yen has been strengthening against the dollar for the past few months, at least off its weakness earlier in the year. And so maybe people were just pricing this in and fading the news. Alternatively, this could be something that is simply just going to take longer to play out. So right now, the notable thing, of course, was that 10-year Japanese yields immediately went above 0.5%. And so testing the new yield curve control boundaries, and indeed the Bank of Japan didn't seem to do anything. So now they're comfortably above 0.5%. But going forward, though, the next time we have a bout of higher yields, so the next time global bonds sell off, that means that they have more room to rise. The Japanese 10-year yield is going to be able to rise up to 1%. And that means that Japanese investors are going to be able to enjoy higher yields, and there's less of an inclination for them to instead move their money abroad and say buy treasuries or some kind of European government bond. All things equal, that's going to mean there's going to be less downward pressure on treasuries and other fixed income assets in the US and in the developed markets, basically, and maybe to the emerging markets as well. I'm not sure how involved Japanese investors are there. So this is a opening where that allows global yields to potentially rise more than they have in the past. Now, Japanese investors could be slow in their allocations, so we'll gradually see this move out, be manifest in the markets in the coming months. All right, so that's all I've prepared. If you like what I'm producing, please remember to like and subscribe. And note that if you are interested in hearing more about my market views or understanding more about the financial system, you can check out my blog at fedguide.com and my online courses at centralbanking101.com. Thanks so much, guys. We'll talk to you next week.